The macroeconomic landscape in mid-2026 is undergoing a major structural shift, forcing investors to completely rewrite their financial playbooks. For the past several months, the global financial community operated under a unified assumption that inflation was safely under control and that central banks would spend the remainder of the year cutting interest rates to support economic growth. However, recent geopolitical disruptions and new trade dynamics have completely reversed that narrative. Instead of preparing for lower borrowing costs, market participants are now bracing for the reality of renewed monetary tightening. Today, we will examine the mechanics of this economic reversal. We will also look at why investors' expectation for 2026 suddenly broke down, analyze the growing structural threat of stagflation, explain why the Federal Reserve finds itself completely cornered, and break down exactly what an environment of rising interest rates, high inflation, and high unemployment means for traditional assets, global recessions, and of course, the price of Bitcoin. To understand the current pressure on risk assets, we must first look at how dramatically investors' expectations have shifted since the start of the year. Throughout the early months of 2026, Wall Street treated interest rate cuts as an absolute certainty. Financial models were built around the expectation that the Federal Reserve would deliver up to 3/4 points rate cuts before the end of the year to smoothly ease the monetary constraints. That narrative has completely unraveled over the past few weeks, and a sudden spike in global energy prices, driven heavily by active geopolitical conflicts in the Middle East, combined with a wave of newly implemented import tariffs, has caused consumer prices to re-accelerate sharply. Recent economic data showed core inflation metrics jumping to an annualized pace of over 4.3%, moving much further away from the central bank's long-term target. As a result, prediction markets and interest rate futures have completely priced out any chance of a near-term rate cuts. Instead, investors are now actively preparing for the possibility of an explicit interest rate hike later this year to stop inflation from becoming permanently unanchored. This sudden shift in monetary expectation is deeply concerning because it is occurring alongside a visible weakening in the labor market. This specific combination introduced the textbook definition of stagflation, a painful economic period characterized by stagnant economic growth, rising unemployment, and stubbornly high inflation. Data from the second quarter of 2026 highlights this growing imbalance. While headline consumer price inflation is projected to reach 4% due to energy pressures, the national unemployment rate has drifted upwards, steadying in the 4.3 to 4.4% range. Furthermore, household surveys indicates that consumer sentiments has fallen toward historic lows as working families feel their finances directly squeezed by the rising cost of basic living necessities. When prices rise while job security declines, standard economic interventions become far more difficult to deploy successfully. This environment places the Federal Reserve in a classic economic bind, caught directly between a rock and hard place. The central bank operates under a strict dual mandate from Congress to maintain stable prices and to promote maximum sustainable employment. Under normal economic conditions, these two goals can be managed sequentially. If inflation rises, the Fed raises rates to cool down the economy. If unemployment spikes, the Fed cuts rates to stimulate borrowing and hiring. However, stagflation completely breaks this traditional policy model. If the Federal Reserve chooses to aggressively raise interest rates to combat energy and tariff-driven inflation, it will inevitably increase borrowing costs for businesses, reduce capital expenditures, and accelerate layoffs, pushing unemployment significantly higher and slowing economic growth. Conversely, if the Fed prioritizes the labor market and holds interest rates steady or attempts to cut them, it risks allowing inflation expectation to become unanchored, causing prices to spiral further out of control. There is no painless policy options available. When interest rates rise during a period of high inflation and slowing growth, different asset classes respond in fundamentally different way due to shifting capital incentive. First, precious metals like gold and silver traditionally perform well during stagflationary periods. They act as historical safe havens and a physical store of value when fiat purchasing power is eroding. However, their upward movement can be partially capped because higher interest rates increase the yield on government bonds, making non-yielding assets like gold relatively more expensive to hold. Second, the bond market faces direct structural headwinds. When the Federal Reserve raises interest rate, newly issued government bonds begin offering higher yields. This immediately forced the market price of existing lower-yielding bonds to fall, leading to significant capital losses for fixed income investors. Third, the stock market faces pressure from two sides simultaneously. High inflation increases raw input costs and compresses corporate profit margin, while higher interest rates raises the cost of corporate debt and lower the present value of future earnings. This makes equity valuation highly vulnerable, particularly in high-growth technological sectors. Finally, the cryptocurrency market historic behavior shows that it is highly sensitive to macro liquidity. Because digital assets generally operate as high beta risk assets, an increase in interest rates draws capital out of speculative networks and back into risk-free, high-yielding dollar assets, compressing overall liquidity. When analyzing Bitcoin's specific reaction to rate hikes, we observe a clear conflict between its short-term trading correlation and its long-term structural narrative. In the short term, Bitcoin reacts primarily as a liquidity-driven asset. When the Federal Reserve tightens monetary policy, the cost of capital increases and institutional investors systematically reduce their exposure to volatile assets to preserve cash. This mechanical capital flight typically exerts downward pressure on Bitcoin's spot price, causing it to trade in tandem with traditional risk assets like the Nasdaq index. However, on a longer time horizon, a rate hike driven by structural stagflation reinforces Bitcoin's core value proposition. Bitcoin was developed specifically as a decentralized, mathematically scarce alternative to central bank management. When investors witness a sovereign central bank struggling to control inflation despite keeping interest rates elevated, confidence in traditional monetary system begins to erode. This long-term narrative can trigger selective capital decoupling, where investors begin treating Bitcoin as a digital alternative to gold. As the Federal Reserve maintains a tight monetary stance to combat persistent inflation, the probability of a policy-induced recession increases significantly. If economic growth decelerates into a formal recession, the impact on Bitcoin will likely unfold in two distinct phases. During the initial phase of a recession, a broad liquidity contraction typically takes place across all global markets. As businesses deal with declining revenues and households face rising unemployment, investors are often forced to liquidate their liquid assets, including cryptocurrency, to cover real-world debts and operational expenses. This phase usually results in a sharp temporary correlation down across all asset classes. The second phase, however, represents a very different environment. To escape a severe recession, central banks and global governments historically abandon tightening policies and return to aggressive monetary stimulus, lowering interest rates and expanding the monetary supply. Because Bitcoin's supply is entirely hard capped at 21 million tokens, it is uniquely engineered to absorb this influx of fiat liquidity and historically leading to massive long-term bull markets following macroeconomic resets. The shift towards potential rate hikes in 2026 serves as a powerful reminder that macroeconomic cycles ultimately dictate capital flows across all financial networks. While inflation pressure and rising unemployment places traditional asset managers in a difficult position, they highlight the complex environment that Bitcoin must navigate. In the short term, reduced liquidity remains a clear tactical headwind for price action. Yet over a multi-year horizon, the structural limitation of central bank policy provide the exact fundamental justification for a decentralized sovereign store of value. Thank you for watching this educational economic breakdown, and if you find this clean, data-driven analysis valuable, please consider subscribing to the channel and also share your perspective on interest rate and bitcoins down in the comments below, and I will see you all in the next video.